Adrian Mowat with us on the show this morning. Adrian, good morning. Many thanks for taking the time out and speaking to us at Bloomberg Quint.
Good morning.
We're showing some bit of resilience to the world market moves in the last couple of weeks, Adrian. Would you attribute it squarely to the change of sentiment post the cross-border tensions have de-escalated? Or is there something else which makes India do well while the rest of the EM pack isn't quite exactly roaring?
Well, I think today's probably been quite encouraging throughout Asia EM. We've had the Chinese market corrected on Friday. It's up today more than 1.5%. We've had Hong Kong moving higher as well. So it seems to me that sort of India is part of that trend. I think it's probably also helpful that we've got the date of the election announced. So the election will be over with in the next sort of 2 months, which is quite good, I think, for investors rather than sort of waiting for that to occur. But I really see the India move as one that's part of a more resilient EM. And the reason behind that more resilience, I still believe, is that positioning in emerging market equities is still relatively low by the global investor. So when you do see profit taking, it tends to be a lot more modest than perhaps you are seeing in the US market.
Adrian, as somebody who's advised large money managers throughout his career, if as you look at what's happening in India right now in two big events, one is this cross-border stress, which still in bits and pieces stays alive, and the election overhang, if I can call it an overhang, in the next couple of months. What would you tell big money to do in a scenario like this? The reason I asked this to you also is that the belief earlier was that until May or until the election results is out, FIs will not take any bite in India. The last 10 or 11 sessions have shown otherwise.
Yes, so I think there's a number of items to comment on there. The tensions with Pakistan, we have seen these in the past, and generally they haven't been an economic or a market event over the medium term. So I think the international investors have taken on board what's happened. As there hasn't been any escalation, it hasn't been an important factor for them. I think with regards to the election, international investors, if you go back 3 or 4 months, were probably a little bit too complacent about the election, with a very strong belief that the current government would get re-elected with a majority. I think their confidence around that has diminished as you've got the state election results coming out and some of the opinion polls. I think it's also important to highlight all the Indian performance in 2018, which was very strong. It was the right market to be overweight in. That has not been the case this year. So the international investor, the global investor, has been repositioning their emerging market exposure away from India in favor of other emerging markets. But remember, when you look at that portfolio asset allocation, you've also got to look to see if there's net inflows or outflows from emerging market funds. And we are continuing to see some net inflows into emerging market funds. India gets less of that flow, but does still get part of that flow.
The talk around, the trade war tensions, once they start to look like they're going to subside, is that most of the foreign money, which had been sitting on the sidelines with regards to investment into China, is going to move back into China in a big way, which again starts to curtail the prospects of India getting any funds. Is that something that's a likelihood?
Well, remember that the market will speculate on what's going to happen with the trade talks. So the speculation in late 2018 was very negative. The comments, the tweets coming out of the White House were negative. We've had more positive indications, including some comments from Larry Kudlow overnight, which indicates that progress is being made. I think the sell-off and then the recovery around trade fears has pretty much run its course. And for the market to move higher on a trade agreement, we'll need to see that agreement being signed. So I no longer see that as a big driver. To me, the key driver for the Chinese story is going to be the macroeconomic data. The macroeconomic data has been very poor coming out of China. But if you begin to look at what's happening with stimulus, which includes both a monetary stimulus as well as a fiscal stimulus with the tax cuts, it is reasonable to assume that the macro data out of China will be improving as we move into mid-year. And I think that will sustain the rally because ultimately equities are about profit growth. We had a contraction in private sector profits in 2018. Hopefully we start to see the market speculating on a recovery in that, particularly as they project profit growth through into early 2020.
We've spoken to a few market participants who are big on India, and according to them, the main focus now for the Indian equities shifts to companies that provide higher return on capital employed than just volatility of the earnings factor. Now, considering that India is still not a very cheap market, it is still trading at valuations higher than its historical valuations, is a company-specific approach something that most foreign investors now are going to be looking at? And the fact that when you break the market into two parts, which is your larger, more well-known names versus the smaller names, which are now starting to gain traction, is there going to be a big divergence of that?
Yeah, I think that's a really important point. And, when I look at the way the Indian market has traded this year and compare it with other emerging markets, there's a big dispersion in the returns between the top and the bottom performing stocks in the Nifty. So even just looking at the large caps before we even move on to the small caps. So investors are very much stock specific in their views rather than it being possible to see some clear sector trends. Now, I think that makes sense for a number of reasons. One is that the Indian macroeconomic environment is really more of a steady as you go, whereas in countries like China, which we've already talked about, but I'd also highlight Turkey, Brazil, Mexico, Indonesia, you're more likely to get a bit of a cyclical recovery being built into market expectations, and you get a clearer sector trend in those situations. The other thing to bear in mind is these sort of strange index composition rules where when you hit the foreign ownership limit, the stocks come out of the indices. Now, what we see with the international investor is they're very happy to hold stocks that have come out of the indices if they are high quality. So definitely this thesis around stock selection and quality seems to continue to be a key factor when trying to invest successfully in the Indian market. Whereas in other markets, just to emphasize the point, it seems to be much more of a cyclical recovery trade that's in place. And in many cases, it's some of the lower quality, some of the lower ROE companies that are performing best year to date, as they have more of a recovery to discount than the high quality names.
Adrian, one final question from my end, really, and that is with regards to what could happen over the next year and a half in India if earnings show glimpses of re-emergence, but not quite. I mean, you refer to the composition of an index that may well play a factor in figuring out in the eventual nifty EPS that comes out. For 4 years, we've waited for the reversal to come. It hasn't quite happened. The hopes are that FY20 could well be the year again, and they could be dashed as well. Do people stay in hope and give these elevated 18, 19 multiples to India, or at some point of time that will reverse?
Yeah, it's a perennial question, really, isn't it? Because the Indian market is typically forecast to give us high teens EPS growth and rarely delivers that. Perhaps it's sort of partly back to the previous question, which is that there are companies in the Indian market delivering consistent high earnings growth. You pay a high valuation for those, but they continue to deliver. And we get the disappointment in the more cyclical names. I don't see anything at a macroeconomic level which justifies such high earnings growth out of the Indian market. If we think about this in terms of nominal GDP, perhaps India delivers around 10% growth. Last year, for the exporters, you had the benefit of a significant weakening in the rupee to nearly 74. Perhaps this year, the exporters get less of a help, and the average exchange rate this year could be higher than it was in 2018. So if I think about the story for exporters and the lack of a clear acceleration in the economy, I remain skeptical about those high EPS numbers, and the vulnerability will be in the lower quality names, which makes one continue to have a relatively expensive high quality portfolio if you're a dedicated Indian manager.
All right, Adrian, thanks so very much for joining us. Really appreciate you joining in this morning with your thoughts.